Hi, my name is Lauren Templeton, and you are listening to Investing the Templeton Way. This podcast is for anyone interested in learning more about investing. In this podcast, I will be interviewing some of the greatest minds from the investment community and exploring topics ranging from international markets to behavioral finance. To learn more, please visit us at investingthetempletonway.com. The information presented in this podcast or available on the website is not intended as and shall not be construed as financial advice. This podcast is produced for entertainment value. Investing is inherently risky, and I encourage you to seek financial advice from a professional who is aware of the facts and circumstances of your individual situation. Thanks for listening. Hi, welcome to Investing the Templeton Way podcast. I'm your host, Lauren Templeton.
And I'm your co-host, Scott Phillips.
We're really excited to introduce today's guest, Ryan Myers. Ryan is portfolio manager at Causeway Capital. He joined Causeway in 2013 and has been a portfolio manager since January 2021. His responsibilities include alpha research, stock selection, and portfolio construction. Prior to Causeway Capital, Mr. Myers served as Chief Investment Officer of Iron Castle Asset Management, an investment partnership focused on mid-cap U.S. equities. From 2007 to 2008, Mr. Myers worked as an analyst at Canyon Partners, where he covered the cable, media, telecom, and satellite sectors. Prior to that, Mr. Myers was an associate for Oak Tree Capital Management in the Distress Opportunities Group, and he began his professional career as an investment banking analyst at Goldman Sachs in technology, media, and telecom group. Mr. Myers earned a BA, magna cum laude, in economics from Harvard University, where he was elected to Phi Beta Kappa. He earned an MBA from the Stanford Graduate School of Business. Mr. Myers also serves on the Board of Trustees of the Yosemite Conservancy, an organization dedicated to supporting projects and programs that preserve Yosemite National Park and enrich the visitor experience. It is with great pleasure we welcome Ryan Myers.
Thank you for having me, Lauren and Scott.
Yeah, so tell me specifically about your role at Causeway and what Causeway focuses on.
Right, so I'm a portfolio manager at Causeway for our emerging markets equity strategy and our international small cap equity strategy. And Causeway in general, we're a global investment manager, approximately 40 billion under management, and we really bring a unique approach to investing where we try to blend both fundamental and quantitative inputs in all of our strategies.
Great. Well, tell me what got you started in investing? What led you to this career path?
Yeah, fortunately, my parents got me saving very early, although it was sort of just in your standard savings accounts. In college, I became much more interested, in high school, in economics, really studying, gained an appreciation for the historical importance of economics in sort of shaping history. I feel that people are really a product of the economic times, the macroeconomic backdrop that they're brought up in. Also, people respond to incentives. And so understanding that is very interesting to me. Took my first corporate finance class in college and just became much more interested in taking, the macro down to the micro, understanding companies. And I think I'm naturally curious. And so I just love learning about new industries, learning about business models. And so, from there, it was sort of a natural extension to sort of go into the buy side and finding companies to invest in.
Yeah, it's interesting that you were interested in economics in high school. It's the dismal science, and you must have had a very good economics teacher too.
I did.
To make you interested in it.
I did. I'd say I became much more interested in college. I got to study with people like Larry Summers and Martin Feldstein, and they really bring a lot of passion to the subject, which makes it easier as a student always.
Yeah, that's amazing. I'm jealous of that. I was an economics major at the University of the South. We call it the Harvard of the South, but it is not Harvard. So I had some good economics teachers, though. I do appreciate them. Well, tell me, in your role at Causeway and your focus on emerging markets and international small cap equities, tell me, what are your views on the current markets specific towards small cap international equities or emerging market equities?
Yeah, I think it's an interesting time, certainly. We're, today in March 2023, I think there's a divergence going on where we see a lot of headwinds to growth in the US, and to a lesser extent in developed international. But, when you turn to emerging markets, you see, China getting a lot of tailwinds from its reopening. You see India as well. Between the two of them, they're about 45% of the emerging markets index, and they're both expected to put up mid to high single digit GDP growth this year. And so you have a very big, counter influence to the slowing growth in the US internationally. And so I think it's a very interesting time to be investing internationally. When you get to small caps specifically, it's also interesting that, small caps typically trade at a premium to their large cap peers because of the perceived growth. And yet now, especially internationally, we see that space trading roughly in line from a multiples perspective with larger caps, which hasn't really happened very often historically. You really have to go back to the TMT bubble, the global financial crisis to see that, them trading at parity, basically, from a multiples perspective.
Yeah, sure. We've seen some of that too.
Yeah, Ryan, following up on that, the international space appears from our perspective very discounted versus large cap U.S. names. And it was interesting to get your insight into the kind of the deeper tranches of the international market, the small caps, and how they're trading in line with the international kind of broader multiples. I'm wondering, to what extent are you seeing differentials between, let's say, Europe and Asia? Do you find all regions attractive? Does one stand out versus the other? What are your thoughts there?
We're finding more opportunities in emerging right now. I think whenever you enter sort of a risk-off stance, like has happened in the last few weeks and months, I think the perceived riskier parts of the investment landscape tend to sell off a little more. So that includes international, that includes small cap, that includes emerging markets. And so I think the intersection of all three is very interesting now. We're overweight countries like Korea, Thailand in our international small cap strategy currently. And part of that is a function of just the fact that, from a valuation perspective, some of those countries appear very attractive, especially when you compare it to the US, which is, the US has outperformed international, both emerging and developed international for the better part of a decade now. But these are inherently cyclical, right? I mean, throughout the 2000s, international was outperforming the US. Late 1980s, late 1970s, same thing. And so, inevitably this is cyclical. I think, Europe is relatively attractive as well. You're seeing, I think there's been a preference for dividends in Europe for some time. And so the dividend yield in Europe has been higher than that in the US for some time. But more recently, the buyback yield is now higher in Europe than in the US. And it hasn't been that case for 20 years. And so I think there's a lot going for international right now. Also, the dollar, the U.S. dollar, has been a major headwind to U.S.-based international investors, again, for the better part of a decade. And if you believe that the Fed is near the end of its current hiking cycle, I think you can make a strong argument that that having non-U.S. dollar exposure may finally, prove to be a tailwind for U.S.-based investors. But is that consistent with what you two are seeing as well?
It is. And, just as kind of pivoting off this conversation towards something that's probably evolving as we speak and gaining steam in these international global perspectives. The banking headlines out of the U.S. have been, I think, shaking up a lot of investors who maybe ignore balance sheets at their own risk, but balance sheets are a huge factor in investing, and you kind of ignore them at your own peril. So I'm wondering, when you look at things going on in the U.S., whether it's Silicon Valley Bank or Credit Suisse, which we'll just refer to as a global franchise for these purposes, you've seen bad behaviors, chasing yield, misallocation of resources. How do you compare what we're seeing kind of being exposed through higher interest rates in the U.S. versus the international markets? Have they gone down these same rabbit holes? What is your view on credit and capital allocation in these markets? Is it a better picture than what we're seeing unfold here?
Yeah, it's a good question. I think in generally speaking, international banks are a little better off than what we're seeing in the U.S. Obviously, in the U.S., what got Silicon Valley Bank into trouble was both a mismatch in duration on their balance sheet, as well as a lot of paper losses that ultimately became realized when they saw depositor outflows. And I'd say, especially within emerging markets, it's interesting because this cycle, emerging market central banks really led the Fed in terms of increasing interest rates. And so, you saw the likes of Brazil, other large EM countries proactively increasing interest rates in advance of the Fed in 2021, beginning in early 2021. And so it had a few effects. First of all, they were used to the higher rates before the US was, and it also insulated their currencies as well to some degree. And so looking forward, I think, if you look at the performance of European banks, emerging market banks, they've largely held in pretty well because they've avoided some of those issues that we're seeing in U.S. regional banks. Now, undoubtedly, we're going to see more regulation coming down for regional banks in the U.S., which will ultimately decrease lending and be yet another drag to economic growth in the near term. But I think what we're hearing too, and as we're learning more about Silicon Valley Bank, Signature Bank, that they had fairly unique issues as well, and probably not the proverbial canary in the coal mine that we thought a few weeks ago. But you're right; it's a reminder that we are in a tougher credit environment, and that's certainly not going away. As you said, it really pays to understand capital structure and balance sheets in this environment. And we've seen, just in the last few weeks, a sell-off in some of the more highly levered companies. Those that need to tap the capital markets in the next few years have certainly sold off more than clean balance sheet companies.
No question. And then, I also think, and this would be interesting to get your view, when you look at the emerging markets in particular, 8% inflation, that really shook up things here in the U.S., but they've seen inflation. You go to Brazil, they've had 1,000% inflation. So there's this institutional memory of these corporate managers in place. They know what can go wrong. They've seen it all. And while people in the U or managers in the U.S. are a little bit flat-footed from all this, I'm wondering if you see like just a more conservative backdrop from a balance sheet standpoint in some of these markets, because these guys know what can happen. They get starved of capital every so often, and they know that they have to be prepared for that.
Yeah, that's fair, and certainly from a macroeconomic perspective, emerging market has had many crises. If you go back to the '90s, certainly you had Mexico in '94, you had the Asian financial crisis in '97, '98, and over time, you've seen a lot of adjustments because of that. You've seen a lot more floating exchange rates. You see a lot fewer external vulnerabilities in the form of current account deficits than we used to see. And so, yeah, certainly that would extend to the, lessons learned into banks as well. I'd say in general, international banks are far more well capitalized than they have been historically, mostly as a result of lessons learned from the global financial crisis. And so if you look at, some of the European bank balance sheets, they're, very strong, relative to the US and relative to certainly how they were post GFC. And so, yeah, you could argue that they're pretty well insulated against any, near-term financial crisis.
So, another question that kind of came to mind. I know we've talked a lot about these kind of macro factors. They're grabbing the headlines. They have everyone's attention. But I'm wondering, just from a process standpoint, tell us a little bit about how you differentiate your weights between macro versus micro, or is your portfolio constructed more on a bottom-up basis, or do you have macro factors that filter in or maybe exclude some markets? Just give us, an idea of how you approach these matters.
Yeah, well, how we approach international small caps specifically is we're, from primarily a quantitative approach, we're able to blend together multiple sources of alpha. Our foundation as a firm is really in value investing, and so value receives the largest weight in the final assessment of any stock. But again, from a diversification of alpha approach, we're able to blend in measures of growth, momentum, what we call competitive strength, which is really quality, assessing a company's competitive moat, but then also blend in certain top-down metrics. And so in international small caps that are a little more driven by company-specific issues, management decisions, the weight is basically 90% company-specific, 10% top-down. When we're looking at the larger cap emerging market space, it's 75% company specific, 25% top down. What we find is that small caps tend to be a lot more idiosyncratically driven. I mean, they're really, their success or failure really comes down to the decisions that management is making, and so we put a lot of emphasis on company specific metrics. But at the same time, you can't ignore what's happening at the macro level. We see there are 24 emerging market countries in our EM universe. There are 46 international small cap countries in our universe. And so you need to make trade-offs ultimately between the opportunity set in all of those countries. And so the macro piece certainly helps us, looking at things like changes in GDP growth, sovereign CDS, interest rate curves, inflation, budget forecasts, current account deficits, foreign exchange reserves. That all matters as a U.S. Based investor. Ultimately, when you're going to take your profits out in U.S. dollars, it definitely pays to understand those aspects as well.
Absolutely. And then how do rule of law and property rights factor in? Do you just take some countries off the table because you're not comfortable?
I'd say the really dicey countries generally aren't in our universe to begin with. Most of the countries we invest in have, some history of strong property rights. We do have certain political risk inputs into our top-down models, so we do try to make an assessment. At Causeway, too, we have a full fundamental team, and so we're not making decisions in isolation. We try to get their input on our entire portfolio periodically to get anything that you can't quantify. Basically, we're realists in the fact that you can't quantify everything in the world. There are certain aspects that are just outside the scope of quantitative analysis. Usually it comes down to corporate events, but sometimes it's regulatory changes, litigation, M&A, things like that that are very difficult. So our fundamental team has been very valuable, especially recently, given recent events, obviously Russia, Ukraine last year, but even more sort of, more specific changes, such as, the Japanese government changed their reimbursement policy for certain healthcare companies a couple years ago, and that impacted some of our healthcare holdings. Our real estate team alerted us to certain irresponsible lending practices on the part of various Chinese developers. And so we exited some of those positions. And so having some of that real world feedback, it has been very helpful for us as well. How do you think about sort of that, where obviously you invest in certain emerging market countries where the geopolitical risks are elevated. So how do you approach that?
We need to feel protected as shareholders, just that there's certain property rights in place. And I think the tricky thing with emerging markets is just from if you're just reading about the country generally and their laws in the books, they all kind of look okay, but then there's a matter of enforcement, and you've got to really figure out to what extent you are protected, and that there's no replacement for getting in and getting local knowledge of the markets and understanding how things really work. Like India is a fantastic example of that. And then China has just changed so much over our investment careers. We held stocks in China, I would say coming out of the taper tantrum. So that was mid 2015 when the emerging markets basically collapsed in value. There were a number of attractive businesses at very low valuations. We bought Alibaba then. But then, by mid 2020, we were completely out of China because we were just unsettled by what was going on geopolitically.
Well, and from a regulatory perspective, you saw a crackdown on online education companies, real estate companies. It's just like one domino after the next. And how do you, ultimately, you would have to know someone within the Chinese government to know, okay, what's next on the chopping block to be really comfortable.
That's exactly right. So it changed so much in that 5-year.
We were very uncomfortable with that, but I want to push a little bit on your process. So you're running a quantitative process. Tell me about your universe. Is your universe the MSCI ACWI ex-US small cap international universe?
That's right. Yeah.
How many stocks are in that universe?
Yeah, so it's a fascinating universe of stocks. There are over 4,300 stocks in that ACWI ex-US small cap index, which if you take a step back and look at the overall international opportunity set, ACWI ex-US IMI, small caps are 14% weight, the way that MSCI constructs their indices, but actually they're close to 2/3 of that universe by number. And then even if you include the US, even if you take a very broad global universe and take the ACWI IMI, those international small cap companies are still 47%. So close to half of the global investment universe is those international small cap companies. And so we just see, a wealth of opportunity set, given that broad index. And that index is unique too in that you don't have the concentration issues that you have in larger cap indices. And so the largest single constituent in that index is only 20 basis points. The top 10 are 1.7%. I mean, you compare that to the MSCI USA, which is very similar to S&P 500. You're looking at 24% weight for the top 10 companies. And so because of that lack of concentration, it's also very difficult for companies to replicate that universe passively. There's one ETF, VSS from Vanguard, that generates 5% tracking error every year to the underlying index that it's seeking to replicate, and that's no ding on Vanguard. It's a byproduct of just the fact that this very broad, flat index is very difficult to replicate on a daily basis, which creates an amazing opportunity for an active manager.
Yeah. What about country exposure within the index? Is there consolidation in certain countries or?
I mean, you see, the largest weights are to Japan, UK, but they're still relatively small. I think Japan's the largest at about 20% of the index. But what's also unique is that China has a much lower weight in small caps than it does in large caps. It obviously has these very big mega cap companies like Alibaba and Tencent. But when you go into small caps, China is only about 2 to 3% weight in the index. And so if you're concerned about some of those issues that we spoke about, it's just much less of a presence overall.
Yeah, that's an interesting point. So you start with this universe, and then you're going to run your model. You'll have your alpha model, and you are using certain factors to weight stocks. And can you tell me a little bit about the factors that you're using? I saw in a past interview you talked about value being the largest component, and then growth, and then some type of quality factor as well.
That's right. Yeah, value receives the largest weight in our weighting. We actually have a unique, every stock in our universe gets a unique weighting. We try to appeal to the marginal buyer of every stock and sort of upweight the most attractive aspect of every stock. But that said, value still receives the largest weight across the board. We have sector-specific models that our fundamental analysts helped us focus on what are the most important value metrics for every sector. Growth matters, both long-term growth as well as shorter-term growth in the form of estimate upgrades. We find that, once the sentiment is changing, that's generally a good time to get on board. Momentum does work, especially in less efficient asset classes, such as international small cap. We look at the focal company's momentum, but also the momentum of the broader network. And so we look at the momentum of a company's competitors and suppliers and customers. Because generally what you see, it's very interesting. There's really a trickle down of information from large caps to small caps. So for example, if Apple reports, really great iPhone sales, it may take a day or two for that positive news to filter down to some of Apple's smaller cap suppliers. And so we find, a lot of value added from just looking at the broader momentum of a company's network. And then finally, as you said, competitive strength. We developed that factor group a few years ago, really in reaction to value underperforming for so long. And it really came down to avoiding value traps, right? The companies that look cheap, but they'll look cheap into perpetuity as their earnings decline to zero. And we really took a lot of inspiration from Michael Porter and his 5 Forces framework. Obviously, he was more focused at the industry level. We're trying to apply that to the company level. But we're looking, for companies with a strong competitive moat, and typically those are companies that exhibit long-term uptrends in margins, in market share, in returns. We also examine the industry structure, preferring more concentrated industries. But then we also look at balance sheet as well. We want to make sure that these companies have a balance sheet that will not get them into trouble during, times like this. And so ultimately we're, through those factors, we're trying to identify the companies with the business models, with the pricing power, with the balance sheets, to do well, in not great economic times, like we're seeing.
Okay, well, this is a really unsophisticated question, but you take the 4,300 companies, you run your screen on the 4,300 companies. That's going to differ a bit per industry, especially when you're looking at valuation metrics. You're going to come up with some type of score. Are you ranking these on the total 4,300 or within industry? And then how do you decide the industry and country allocations? Are you trying to match the index, or you're looking at the total overall rank of the 4,300 companies, like a composite ranking? Does that make sense?
No. Ultimately, you're right. We're trying to rank the entire universe. The advantage of a quant approach is we can do that very easily on a daily basis, and look at the entire opportunity set, from most attractive to least attractive. You're right. There are some issues with comparing two companies. And so that's why we typically sector neutralize and country neutralize our value scores. And so we're not comparing, directly comparing emerging markets to developed. Obviously, there's a valuation difference there. We're not directly comparing financials to, let's say, IT. Obviously, there's sort of a structural multiple difference there as well. So we're looking for cheap companies within their sector and within their country when we're doing those comparisons. We do, and that tends to create a fairly balanced portfolio just by itself. We do have certain portfolio level constraints, so we'll constrain our country exposures to plus or minus 5% of the index. We have a fairly tight, even at the stock level, plus or minus 2% versus the index. As I said, in the case of international small caps, the largest constituent is only 20 basis points by itself. And so really it's just an upward cap on exposure.
So how many stocks are typically in your portfolio?
In our international small cap strategy, typically we're at about 135 today. It ranges between 120 and 200. We're a little more concentrated versus a typical pure quantitative manager, which some of them have hundreds of stocks, and partly because of our fundamental team gives us more confidence, more conviction in the stocks that we do hold.
Yeah, I'm surprised that you actually said 120 to 200, because I also read that you're optimizing the portfolio for 100 different risk factors. And I would have just guessed your answer to be like 300, 400 companies, because when you get those super optimized portfolios, you need all the holdings.
Yeah, that's true. It's very easily to go sort of overboard on the risk and really over neutralize a portfolio. We do have a sophisticated approach to risk where we, really whenever you're buying a stock, you're buying, I like to think of it as you're buying a basket of risks with uncertain payoffs. And a lot of those risks are company specific, but far more are shared risks with the country you're investing in, or the sector, or the currency, or even the style of the company that you're buying. And so our risk model tries to, basically assess how well a stock will fit into the portfolio, how well it will diversify existing risk exposures. And so ultimately, when we optimize the portfolio, we're trying to find the highest expected return per unit of risk. But it's just so fascinating, again, going back to the universe, the international small cap universe. If you take the average correlation between every single pair of stocks in the universe, it's only about 0.25. So the universe itself is so well diversified that if you start putting these into a portfolio, you get much greater diversification benefits than you do, let's say, in a U.S. large cap portfolio, where the correlations tend to be much higher.
Much higher.
Yeah.
Well, that makes sense. So you rank the companies, you're optimizing for certain risk factors, and then at what point does the fundamental team come in and take over? Is it right? I mean, that seems like a lot of stocks for the group to cover, but at what point do they jump in and do stock-specific analysis, or are they looking at industries? How does it work?
Yeah, so they give us input on trade dates. So whenever we're doing a rebalance of the portfolio, we'll send the new stocks that are entering the portfolio to our fundamental team. We also have a standing monthly meeting where we will basically review the entire portfolio, and especially the largest active weights. And to the extent that they see something that's really not being picked up in our quantitative models, they'll provide that feedback, and ultimately we can kick a stock out of the trade list even before it enters the portfolio. Or, if something happens after the fact, obviously we had a few Russian holdings in early 2022 before the invasion, but some feedback from them helped us exit those names fairly quickly, and so ultimately it's an innocent until proven guilty approach, I like to say. So we're not, we're not in the business of just overriding our models every day. It really has to be something truly outside the scope of our models that's not being captured. But call it 2 to 3 times a quarter, we will trim a position back, or we will kick it off the buy list even before it's in our portfolio.
Sure. It's very interesting to me. I think most people don't realize how quantitative John Templeton was. He was so quantitative. He just did it in a time where you couldn't download information from Bloomberg to Excel, and you just didn't have the computing ability that we have now, and it was much harder to do, which gave him an edge. But all the strategies I started and ran with him over the years all had a major quantitative component, and the way his 3 foundations manage money they have a very quantitative process involved with manager selection and monitoring managers. And I'm always quick to remind the committee that if you're going to run a quantitative process, you have to consistently adhere to it. If you go in and override it all the time, you're really defeating all the benefits you get from running a quantitative process. So it's really a very interesting approach to international small cap equities and emerging markets. I think it's really smart what you guys are doing. I have 2 more questions. Maybe more, but 2 that immediately come to mind. One is, I would suspect there's a good bit of turnover in this strategy. Am I right or wrong?
There's a fair amount. It really depends on the alpha decay of every factor you're looking at. So value in particular tends to be a factor that pays off over a long period of time, as you're well aware of. And so once you blend in certain measures like momentum and earnings growth and sentiment, those tend to turn over a little faster in terms of what ranks high or low, depending on your time frame. But overall, we target a turnover below 100% annually in all of our strategies. And some of our more fundamentally oriented strategies are even far lower, more like 30%. And it really ultimately comes down to your weight on value, because we all know that value pays off over a long period of time. And going back to, Templeton, obviously he was one of the first sort of adherents to behavioral finance too, which is really a core tenet in quantitative investing, because one thing that we like to do before we introduce a new factor is really understand why it works, right? And usually it comes down to some risk-based reason or behavioral-based reason or a limits to arbitrage-based reason. But, you take value and you say, okay, why does value work? It's been around for decades, even longer. It should be arbitraged out by now. And yet, you come back to some risk-based reasons, which are, okay, people think value companies are riskier. They may be prone to default. You get into a whole host of behavioral reasons why value works, right? People like to buy the story stock that's very popular that you can easily, talk about this, long-term growth projection in the future. There's also sort of a lottery aspect to people investing where they want to go for the company that's going to get them, 10x their money, right? But at the end of the day, those companies usually fail to perform, fail to really match the high level of expectations that are set. And so these things work and they continue to work. And it removes, a quantitative approach, or at least some quantitative input to your process allows at least some level of removing those emotional biases that are really hardwired into everyone, right?
It's a discipline, and that's what I like about value investing. But I think Uncle John was so wise when I started investing with him to make the strategies very quantitative, because I think he was like, she's 24, she's never going to be able to manage her emotions, so I'm just going to remove that component for her, and we're going to be managing this simple quantitative strategy, and I'm not going to let her override the strategy. I think that was genius. And then you do that for a number of years, and you become accustomed to occasionally losing money and not being upset about it and seeing it as a part of the process. And you're not always right 100% of the time. He said he was right 60% of the time. So all of that makes so much sense to me. How do you make the decision to rebalance? Is it, we just rebalance every quarter, or is there something you're looking for that causes the rebalance?
We do. We actually run sort of a theoretical optimization every day to look at so at any point in time, you have the theoretically optimal portfolio that you would pick, and you have your current portfolio, right? And over time, if you don't trade, those two will diverge. Now, to get from your current portfolio to that optimal portfolio, you have to trade, you have to undergo turnover. That's market impact, that's direct trading costs in the form of commissions and stamp duties, and exactly. And so and that's guaranteed negative alpha, right? When you spend that money, you're immediately losing that portion to alpha. And so it's really a trade-off. And that's something that we try to analyze really on a daily basis. We see, okay, how much theoretical alpha could we pick up by trading the portfolio? And we look at that question under different turnover scenarios. And so that enables us to both make the decision of when to trade, but then also how much turnover to use in a particular trade. So in more volatile periods like we're seeing now, we may end up trading a little more often, expending a little higher turnover overall because of the changing opportunity set. But ultimately, to come back to your question, it usually works out to about once or twice per month that we're trading, and typically it's lower, relatively lower turnover. Again, we're targeting something below 100% annual turnover, but it's a great question and something that we analyze quite a lot, because ultimately it's a question of how much can you improve your portfolio by undergoing that turnover.
And then how much are you tinkering with your model or strategy? John Templeton always said there are 100 measuring sticks of value. If you focused on what worked best 5 years ago, you're going to miss what's going to work best in the next 5 years. So I imagine that you have to be adjusting some of those factors over time. What does that process look like? I mean, is it you all meet in a conference room and talk about it? Or, how does it work? Yeah,
you're right. I think quantitative investing needs to be evolutionary because, certain aspects do tend to be arbitraged away over time to some extent. And so you need to adjust. But at the same time, as you said, you don't want to kick something out of your model just because it hasn't worked in the last year. And value is a great example. Value went through, a very large period, extended period of underperformance in the 20 teens up until recently. I know. So where does that leave us? 2 years ago, we could have looked at a back test over the last 10 years and said, well, why do we even have value in our model? It hasn't been working. And that's where it really, comes down to having a long-term perspective, looking at these performances over very long periods of time, understanding the reasons why a particular factor works. Again, coming back to identifying a risk-based or behavioral-based reason why it works, and therefore why it should continue to work going forward. But ultimately, we're constantly looking at new data sets. Obviously, just with the proliferation of data, there are, vendors sort of knocking on our door every day with some new data set. And some of them add value, some of them don't. I'd say, 90% of the new factors we look at ultimately don't go into our models. We want to make sure that we understand why a factor works. We want to make sure it works over a long period of time. And we also want to make sure we're not replicating anything in our model, that's in there already. If you introduce a new factor that's very highly correlated to something else, that sort of just confuses the model, creates some other issues too. And, you ultimately don't want to, when we bring in a new factor, ideally we want to see it very lowly correlated with the other factors that are in our model.
Yeah.
So it's a very high bar. Yeah.
So I have heard you comment on machine learning and how you guys are using machine learning to scrub earnings call transcripts. Can you speak about that, and then also about any uses of artificial intelligence or how that might be influencing your portfolio, or you might be thinking about using these tools?
Yeah, it's obviously a hot topic these days, especially with everyone's been talking about Chat GPT and how, high school students are now not writing their own essays. They're just asking, please write me an essay on 20th century mercantilism or something. I'd say, one of the pitfalls of quantitative investing is the danger to overfit a model, is to look for patterns where patterns don't exist or where they shouldn't continue to exist going forward. And so I could, I'm just coming up with a hypothetical example. Let's say, all of the companies that started with the letter R last year outperformed the market. Well, do you really want to create a strategy around buying the companies that started with the letter R? Probably not, because there's no reason that should continue going forward. And one of the big dangers with machine learning is it's sort of the ultimate overfitting machine. It will find patterns, whether there's a pattern to be seen or not, whether there's some causal relationship or not. And so we've spent, a lot more time than we typically do improving some of our more machine learning based factors. And as you mentioned, we're spending a lot of time using natural language processing to analyze conference call transcripts. And ultimately, we've been at it for over 2 years now. We still haven't gotten comfortable enough to add it to our models because we've basically been in a road testing phase for some time where we now have it automated so that every single transcript that comes out in a day is summarized the next day and sent to our fundamental analysts. And it picks out the specific phrases and keywords that it's latching onto to derive sort of a sentiment score. And ultimately, we want to make sure that our fundamental analysts who are actually listening to these calls, who actually know the companies, agree with the assessment of the algorithm's read of the transcript. Because if that doesn't match up, then again, we're just sort of overfitting a model.
And does it usually?
Well, we've made a lot of refinements. We're getting to a point where we're starting to feel comfortable. We will likely add that component to our models sometime this year, but after a lot of work. And it really just underscores the importance of understanding, how the model is working and understanding, why that factor or that sentiment score should continue to work. And because I think, again, it's a major pitfall to that technology. It's amazing technology for what it does, but it's dangerous just to close your eyes and have a machine pick stocks. Yeah.
Sure. And I'm sure, if I were the fundamental analyst on your team, I might be like, absolutely not. That does not match my sentiment score because I'm worried about my job.
Yeah. It's happened. And what's interesting though, is we've seen companies start to adapt to a machine learning world. And so it's very interesting. Some companies, before they deliver their prepared remarks,
Yes.
they will run it through machine learning algorithms to make sure that it's interpreted positively, which is just crazy. And
I'm sure they're avoiding certain words.
Well, the advice is to repeat certain words.
Yes.
That's a big set of advice that you will hear companies.
Whole new world of earnings gamemanship.
Oh, totally. And, and in the early days of machine learning, it was all about, okay, how many analysts are congratulating the management team? How many times does the word congratulations appear in the Q&A? And that was an easy signal. But, we think that there's a lot of gamesmanship now going on with that regard.
I'm sure. Well, let me ask you this question, and you can answer it for your strategy, you can answer it for yourself, or you can answer it for Causeway as just a business. What is your competitive advantage? If you had to name one thing, what is the competitive advantage of Ryan Meyer, Causeway, or the quantitative approach to international small cap stock selection? Choose either one.
With regard to international small cap specifically, it's an area that would be difficult to cover purely fundamentally, I would say. With 4,300 stocks, let's say you have an analyst covering 100 of those stocks. You still have to have 43 analysts. Because of the market caps, you're only going to be able to run, we measure capacity, or we estimate capacity to be 2 to 3 billion overall. And so it's an interesting space because it's very difficult to cover purely fundamentally. You have to have, a big disadvantage to pure fundamental analysis is it takes time, right? You're gonna spend days, weeks analyzing a company, talking with management teams, and at the end of the day, you may ultimately say, okay, well, it's fairly valued. Let's move on to the next one. And that's a big advantage to a quantitative approach. In that, we can assess the universe, we can identify mispricings really on a daily basis. But that said, quantitative analysis has plenty of pitfalls too. It tries to oversimplify the world. It misses certain aspects that are outside the scope of quantitative analysis. And so, coming back to your question, I think a big competitive advantage of our approach and of Causeway is really the blending of quantitative and fundamental inputs, because at the end of the day, I think both have their strengths, both have their limitations, and so combining them in some respect, hopefully, gives you the benefits of both approaches and minimizes the limitations. But it's hard to do. I mean, they're ultimately different approaches to the same question, and sometimes you arrive at a different conclusion.
Yeah, and I loved earlier how you highlighted the behavioral aspect, because that, to me, from a quant standpoint, that may be the biggest gift. Not only do you avoid the story stocks, most likely, if you're a value-based manager, but it's probably, in our experience with John Templeton it's going to force you into some names that, as a fundamental guy, you probably, I don't know about this one. And so there's so many advantages to that starting point. Do you ever find, like, when you're putting together your portfolios, a stock shows up, you're like, fundamentally, like, I don't know about this, but you have to go with the model? Or how do y'all sort those out, those situations?
Yeah, I mean, I look at certain examples of, because we're diverse. I mean, I'm a value investor at heart too, and so I wanna get a bargain. But occasionally, our model will come up with these stocks that that score pretty average on a value metric, but the growth and momentum is just all there, and all the stars are aligning. And yeah, it sort of makes me question when we have a stock right now. An Indian small cap company that does sort of automated driving software that trades at 40 times next year's earnings. And as a value investor, I'm like, oh my goodness, what are we doing? And yet that stock has been one of our best performing stocks, over the last few months. And so I think at some level, yeah, you need to be comfortable with the diversification of alpha approach. The fact that, sometimes you do have to pay for a stock, up for a stock, right? I mean, if you just take a very simple approach and say sort of, the price is sort of, you're taking an annuity approach to earnings, and ultimately you should be willing to pay more for a company where those earnings are growing higher, and or where the volatility of those earnings is lower. But you have to really have a systematic approach to that, and be comfortable at the end of the day that your process is finding good bargains, whether they're trading at a 3 PE or a 30 PE. Yeah. I don't know.
And really what I was getting at was kind of the other side of that coin, like the names that look scary or dicey. They're in the headlines for the wrong reasons, but your quantitative model is probably saying, no, guys, this is one of them. You got to buy it.
You're right. Yeah, no, I think my background in distressed debt gives me some comfort in thinking that ultimately most assets have some value, right? It's just a matter of coming up with the fair price for that asset. And I think as a credit investor, you approach the world thinking, okay, what can go wrong with my investment thesis? I don't have to have the equity worth anything for me to make money. I just need to, make sure if I bought these bonds at 60 cents on the dollar, I just better be sure that the company's worth that much. And as long as it is, then I'll make my money back. As an equity investor, I think inherently we're trying to say, okay, what can go right? But the value part of the investor mindset is also asking, what can go wrong? And I better be ultra conservative on my assumptions, and the stock, still has upside from here. And so I think you're right. It's a very, sometimes you really, it helps to sort of follow some framework, some rules-based approach to investing. Because, yeah, Lauren, you said that, Templeton was right 60% of the time. 60% looks pretty good to me.
Yeah, I'll take it.
Exactly. If you can get a successful investment 60% of the time, you're definitely going to succeed.
Yeah, that was really well said. I appreciate those comments. So we have been recording now for about an hour. I have one last question for you. And it's just, what is keeping you up at night right now? What are you sitting there worried about when it comes to the market or this particular strategy?
It seems like there's always a lot to potentially worry about. I think, geopolitical, the geopolitical situation is something that we try to think about and try to review periodically. We get a lot of questions from our investors right now. Since we invest in Taiwan, is China going to invade Taiwan? Well, we don't think so imminently, but we also didn't think that Russia was going to invade Ukraine early last year. And so I think assessing the geopolitical risks is something that's difficult. And it's difficult to do from a systematic perspective. How do you really assess some of these larger geopolitical risks? It's very difficult to do. The macro backdrop, I think I'm less worried about because, we're all used to going through investment cycles and, I think a lot of people are saying, well, the Fed was too late to tighten and now they're potentially over tightening. That I think I'm less worried about. I think it will ultimately work out. I think inevitably, though, whatever happens, we're in a higher cost of capital environment than we've been for the last 10 years. And I don't think that's going to change. And so that, and as long as that doesn't change, I think value investing is going to have, a decent runway from here. And so we're certainly optimistic looking forward from that front.
Fingers crossed.
Yeah, exactly.
I hope so. Well, I really appreciate the time you've spent with us today. And this has been a great hour. I've learned a lot, and I appreciate hearing about your background and your strategy. So thank you so much.
Well, thank you both as well. It's been a pleasure.